In 2026, over $1.5 trillion is managed by AI algorithms, not human advisors. These are robo-advisors, and they're changing investing. But are they worth it? Let's break down what they do, costs, and whether you should use one. A robo-advisor is automated investing. You answer questions about age, income, risk tolerance, and goals. The algorithm builds a diversified portfolio of low-cost ETFs, usually index funds. It automatically rebalances and executes tax loss harvesting, completely hands-off. Top 5 platforms in 2026. Betterment charges 0.25% annually, no minimum. Wealthfront is 0.25 with $500 minimum. Schwab Intelligent charges 0 fees but requires $5,000 minimum. Vanguard Digital is 0.2%, lowest fee, needs $3,000 minimum. SoFi charges 0 with $1 minimum, most accessible. All offer automatic rebalancing and tax loss harvesting. Now, costs. Human advisors charge 1% annually, sometimes 1.5. On $500,000, that's $500 to $7,500 yearly. A robo at 0.25% costs $1,250, savings of $3,750 every year. Over 20 years at 7% return, that fee difference compounds to over $200,000. Fees matter massively. Advantages: number 1, low cost. Number 2, no minimums on some platforms, start with 100. Number 3, automatic rebalancing. When portfolio drifts, stocks up, bonds down, Robo rebalances automatically, selling overweight, buying underweight. Number 4, tax loss harvesting. When investment drops, Robo sells at a loss, immediately buys a similar asset to maintain allocation. Loss offsets gains elsewhere, reducing tax bill. Saves $200 to $1,000 yearly. Number 5, no emotional decisions. Humans panic sell during crashes. Algorithms stay disciplined. But disadvantages exist. Number 1, no personalized planning. Can't help with estate planning, insurance needs, advanced tax strategy beyond basic tax loss harvesting, or major life decisions like buying a house or starting a business. Number 2, limited options. You get preset ETF portfolio. Can't request specific stocks, sector funds, or alternatives like real estate or commodities. Number 3, no behavioral coaching. When market crashes 20% and you're panicking about retirement, a human advisor calls, walks you through it, talks you off the ledge. Robo sends an automated email. Studies show human advisors prevent emotional mistakes worth 1.5 to 3% yearly in avoided losses. That behavioral value can justify higher fees. Who should use robo-advisors? Great fit if portfolio under $250,000, straightforward finances, comfortable with technology, disciplined enough not to panic sell during downturns. Perfect for young professionals, early investors, anyone building wealth from scratch. Who should avoid? Complex finances with business income, stock options, rental properties, or inherited wealth need personalized advice. Net worth over $500,000, 1% fee for a human often pays for itself through advanced strategies. If you panic during volatility, you need accountability. Here's the hybrid approach I recommend. Use Robo-Advisor for core portfolio, get low-cost automation, hire fee-only CFP for hourly consultation once yearly, pay $400 to $800 for meeting, get expert advice on taxes, retirement, estate without paying 1% annually. Best of both worlds, low-cost management plus strategic human guidance. Smartest approach for portfolios between $50,000 and $500,000. Action step: under $50,000 invested, open Robo this week. Betterment or Wealthfront, both excellent. Set automatic contributions. Over $500,000 or complex finances, interview 3 fee-only advisors. In between, use the hybrid approach. The important part isn't robo versus human, it's investing consistently, keeping costs low, staying disciplined through market ups and downs. That's what builds wealth long term. Subscribe for more investing strategies every Tuesday and Friday.